Hello and welcome to the show. We call this Molotsky on Money. What's the show all about? Well, the clues are in the title. We'll be discussing money, specifically investment strategies, taxes, estate planning, insurance, and many other topics, all of it designed to help you and your family improve your overall financial picture. The Molotsky part of our title comes from our panel. Their name is Molotsky. Each week we'll have Stan Molotsky, president and founder of the SHM Financial Group, as well as Lee Molotsky, vice president of the SHM Financial Group. Stay tuned because we have valuable information on tonight's show that we hope everyone can benefit from. Stan, in this particular environment where interest rates, and as we're doing the show and at the time of this taping, interest rates are creeping up a bit.
More than a bit.
More
yes.
than a bit. Mm-hmm. So we're going to do a show on what could happen to you when interest rates go up. But should people always be concerned about interest rates and where they are?
They should have their particular portfolio in a way that regardless of what happens to interest rates, that their basic portfolio is totally protected and that they can benefit from when rates go up and they can benefit from when rates go down. That's our job, is to structure those kinds of situations for our clients.
We do a weekly radio show. You've said this many times, and I always scratch my head when you say it, because no matter what you say, when the market goes up, you get some of the gains. When the market goes down, you don't lose. So you're talking about a particular situation. Would you explain that?
Well, there are different kinds of programs that are available to people if they're presented in the proper way. Our job is to find the different programs that make the most sense for the client's goals, objectives, risk tolerance, where they are health-wise and what they're trying to accomplish. And there are different programs that are currently available that say, okay, you make a deposit in this particular vehicle, and when the market goes up, if interest rates go up, you get a participation of that, not all of that gain. The market or the interest rate environment changes, your principal stays the same. It does not go down. So in each year, each 12-month period, you get a gain. That becomes your new principal, and you can't lose that. So it's a way to participate in whatever's going on, not 100% participation, but maybe 30 to 70% participation, if not more, with no risk to the deposit, regardless of what happens to interest rates or the stock market, whether they be U.S. stock markets, foreign stock markets, whatever the selection may be. So it's a way to get involved into the different programs with no loss of principal, regardless of what happens.
Lee, is that a good thing for people, for investors, when interest rates go up? Is that something they should be happy about?
If you're sitting on a pile of cash, or you have a couple $100,000 worth of CDs about to mature, and you're looking to renew those CDs, it's a great thing. But in many regards, it's not a good thing. It has a lot of negative effects depending upon how your portfolio is positioned. So we've seen a deterioration in interest rates over the last 10 to 15 years to their basic, your lifetime, Dad's lifetime, my lifetime lows. We've never seen interest rates this low. So now as interest rates rise, it's going to be a whole nother ball game over the next 3 to 5 to 7 years.
Something you got to watch all the time, right? If you're an investor, and certainly in your position, you're always watching it, correct?
Well, you have to be completely aware of the effect on your portfolio. That's why some of the things we'll be talking about tonight analyze and show you the effect negatively and positively based upon the positions that you have.
And speaking of that, Lee, you were talking about that things could happen negatively if interest rates go up. We want to show you this chart, and again, what could happen when interest rates go up. If interest rates rise by 0.50%, the impact on the principal value of your bonds would be as shown below here. Stan, you want to explain this for us?
Well, basically, you have, as the rates environment changes, keeping in mind that the interest rate environment is coming off of a 30, 40-year deterioration in interest rates. So we all know at some point that's going to reverse itself, as it looks like it's starting to as we speak. And as that, if you put that chart back up there for just a second, as you look at this, it just basically shows that, well, maybe put it up for more than a second. There, that's okay. Now, as the interest rates move up, it shows the deterioration in value of that particular piece of paper, whether it's a 2-year bond, treasury bond, 5-year treasury or 5-year bond, 10-year treasury, 10-year bond, 20-year, 30-year. It shows what a small rise in interest rates has done to the value of those different bonds. And at the same time, part of our strategy, part of what we try to do for clients on anticipation of these things is to use different instruments that say, okay, this may probably happen. Therefore, to protect your total package, why don't we use what are called inverse situations, which in turn will go up in value as interest rates go up versus bonds which are going down in value. So we've been positioning clients in some of those things that have actually gone up as interest rates have gone up. They're inverse type situations. Again, it's part of the planning process with clients to say, okay, here's a way to take advantage of what is currently going on.
In this particular situation, interest rates are going up, and you showed the value of your portfolio going down when interest rates go up if you're in bonds.
That portion, correct.
That portion would go down. So are you now looking at all of the clients that are in that, and are you suggesting to move to what you just mentioned?
The answer is yes, and we've been doing this for the last 6 months. In a lot of cases, we were a little premature, but we would prefer to be premature than way too late. So we have been doing this for clients, like I said, for the last 6 months or so, on anticipation of what is going to happen. And at some point, interest rates will go up as they seem to be starting now. How much higher they go depends on the economic environment. The economic environment is, let's say, sloppy at best. It's not particularly good, it's not particularly bad. It's sort of like bumping along in different places. It's doing a little better than in other places. It seems to be getting better generally, but it'll be a while before that catches up, and it'll be a while before the government can come totally out of the bond market to support these different things.
Lee, when you're talking about bonds, is that something people should be looking at when interest rates are low, as they have been, and then as interest rates go up, bonds are not as attractive? Is that kind of a general statement?
I'm going to use a very simple hockey analogy, right? The greatest hockey player of all time, not Brian Propp, love Brian Propp, but not Brian, was Wayne Gretzky. And what he did was, when he went to pass the puck to his teammates, he would pass he wouldn't pass the puck to his teammate, he would pass it to where his teammate was going, on anticipation of his teammate getting there. And as the guy got there, he picked up the puck in stride, and he became like the greatest passer and greatest player of all time. So on anticipation of interest rates rising, what we've done is positions our clients so that as rates rise, not only will they not lose money, but they will gain money in the interest rate environment, in the bond market.
So you're reacting, as Dad said, you're reacting sometimes prematurely or anticipating prematurely, but better than too late.
The knee-jerk reaction is really what we're trying to avoid. Oh my God, interest rates are starting to move up. On anticipation of interest rates further moving up, we're positioning prior to that event. So will they continue to move up over the next 2 to 3 to 4 years? Perhaps, but now is a time to really sit down and analyze your bond holdings as interest rates have come all the way down and now are starting to rise, quote, from the ashes.
But there are so many instruments out there for clients to take advantage of, if they're exposed to them, that will allow them to benefit no matter what the circumstance would be. If you think the stock market is too high and it's about to deteriorate, there are things that you can purchase that will go up as the market goes down. And these are the kinds of things that we're constantly looking at to help our clients weather the storm, so to speak.
All right, we have a lot more to talk about here on the show. We're talking about what happens when interest rates go up. Well, yes, we do have more to talk about, more to show you. It's Molotsky on Money. We are here every week at this time. I'm your host, John DeMasi, with Stan and Lee Molotsky, and yes, we are coming back with more of this edition of Molotsky on Money right after these words. Don't go away.
Since 1958, the SHM Financial Group has been providing sound financial insights and strategies for people just like you. Founded by Stan Molotsky, the SHM Financial Group believes in safety, security, and preservation of principal. For more information on how the SHM Financial Group can help you, contact them at 1-800-MONEY-SHM. That's 1-800-666-3974, or visit them at shmfinancial.com. Call us to discuss the reverse mortgage concept. If you should decide to proceed, you're required to go through a 60-minute phone or office interview. We will provide you with a list of HUD counselors you can call who will provide you with the counseling. Call us at 1-855-HUD-REVERSE. That's 1-855-483-7383.
Welcome back to Molotsky on Money with Stan and Lee Molotsky. I'm your host, John DeMasi. Don't forget, if you have questions about anything we're talking about, not only on tonight's show, but if you have financial questions in general, feel free to give Stan or Lee Molotsky a call. We flash up the number on the screen from time to time, as well as their email address and their website. You can contact them any of those ways, and certainly they'll be happy to talk to you. If you want to sit down with them and go over your issues and situations, feel free to call them and schedule that appointment. Tonight, here on Molotsky on Money, we are discussing what happens when interest rates go up. And Stan, I guess my question, and a lot of people's questions, why is it that when interest rates go up, bond values go down? Why is that?
Well, if you bought a piece of paper 3 months ago and it was yielding 3%, and today if you could buy another piece of paper and it's yielding 4%, which would you purchase?
The 4%.
Obviously the 4% one.
Right.
But what happens to the one that you bought at 3%? Well, in order to that to compete in today's world, it has to drop in value so that that same piece of paper yields the 4% that the new interest rate is earning. So as interest rates go up, the older pieces of paper at the lower rates have to come down in order to equate to that. If you look at, just remember, if you're taking your children or grandchildren to the playground, and you get on that thing that's called a seesaw. Okay. As one goes down, as interest rates go down, the value of the bond goes up. And it's the same thing in reverse. As interest rates in turn go down, then, or when interest rates go up, the value of that bond deteriorates.
And Lee, based on that explanation, it seems to me that you would want to buy short-term bonds. Is that fair to say?
It depends upon your goals and objectives, but rather than long-term bonds relative to long-term bonds, the answer is yes. You're going to get right now a higher yield on a long-term bond, but the risk associated with principal deterioration on that long-term bond is significantly higher than the short-term piece of paper.
But at the same token, you know, to be devil's advocate, you could take a 10-year piece of paper and you could get a return, 3 to 4 times greater than you can on a 2-year piece of paper. And if you look at that as part of your laddering strategy, you go out longer to get the higher rate and you hold that to maturity over that 10-year period, will you in turn have earned more in interest than you would by constantly reviewing for the shorter term periods at lower rates?
And you could, right? You
could.
earn more, right?
So it's a matter of, and the answer to all this is nobody knows what's going to happen. Nobody knows, no
You
matter
mean
who.
your crystal ball isn't on here?
We have the crystal ball back in the office, but again,
The batteries are worn out.
The batteries are worn out. That's exactly.
It's true.
So our goal in helping clients manage their money is to look at all the different contingencies, look at all the different things that could possibly happen, and put people into different vehicles that will allow them to survive and maintain their buying power regardless of what happens to the interest rates, the stock market, the economy, all those different things. And we have the ability to do that because we do not have a specific product line that we have to offer to clients. I mean, there's some great advisors out there doing whatever they do, but sometimes they're restricted based on who they represent, meaning their company. We don't represent a company, we represent the client to go find what makes the most sense for that client at the particular time.
Okay, we're talking about tonight here on the show what could happen when interest rates go up, and we're trying to show you some examples. This is going to show you if interest rates rise by 1%, the impact on the principal value of your bonds would be, and we have the chart here. And Lee, you want to kind of walk us through this?
Yeah, I mean, just somewhat recently, let's look at the 10-year Treasury for a second. If 10-year Treasury was 1%, so not that long ago was 1.6%. If it rose by 1%, that would make it 2.6. Well, it's risen from 1.6% to 2.4%, 0.8%. Right? That's a 50% rise in the value. And if we look back on that chart for 1 second, you'll see a 7% loss. If your portfolio was in the 10-year Treasury, you'd see over a 7% deterioration in the value of that 10-year Treasury.
Well, it could be a package of bonds that
Yeah.
had 10-year maturity.
Yeah,
The
absolutely.
10-year Treasury is like the guide in relation to that, and it's an index that we follow pretty regularly as far as anticipating interest rate movements. And the 10-year Treasury over the last,
90 days.
90 days, 120 days, is up about 50% in value. It's the at the highest level it's been in the last couple of years.
I don't want to interrupt, but the rate has gone up 50%.
Correct.
So
Okay.
therefore,
Looking at that chart, if interest rates rise by 1% and saying what you just said, and looking at the various different numbers on this particular chart, it seems to me that it's risky to put your money in that kind of a thing. Am I right on that? I mean, you're the financial advisors, but
Yes
I'm
and
just,
no.
Well, let's say this.
Yes and no. For example, if you feel that right now they've moved up too much, the interest rate, and therefore the economy isn't that good, and it may not be, that interest rates may level here and then possibly come down a little bit over the next 6 to 12 months because they've moved up so fast. Therefore, you can purchase that particular piece of paper at that particular rate, which is now higher than it was 6 months ago, on anticipation that it's not going to go lower or higher. So it's a matter of staggering what you're doing, having options out there, and then taking advantage of the different things that present themselves.
I want to convey the fact that we feel, as fact, that the Treasury obligations are a direct obligation of the government, and they are among the safest of all the instruments available out there. However, along your 10-year ride, if you're in a 10-year Treasury, the effect of rising interest rates will deteriorate the value of that 10-year Treasury security during the 10-year period. So right now we've seen a significant movement up, therefore we've seen a significant deterioration in the 10-year. If held to maturity, then your principal is intact.
therefore making that investment, even though it's safe, there is somewhat risky because of the nature of what it is.
During
during
the
that-
course of its lifetime, that's correct.
But even if, just look at that. Take the 10-year Treasury today as we speak. The rate on that 10-year Treasury today is 2.41. 4 months ago, it was close to 2. 6 months ago, it was like 1.5. So it's moved up dramatically. Now, if you bought that piece of paper, you would have the rate that you have, and you have appreciation in that piece of paper. The problem is, like Lee said, if you hold that to maturity, in 10 years, you get your money back. That's fine, and you get the interest during that 10-year period. But if you look at the inflation rate, it's higher than the rate you're getting on that 10-year piece of paper. So at the end of 10 years, you're still behind the 8 ball.
You lost money, right?
So again, you look at all the different things and try and construct something that makes the most sense for the client based on what they're trying to do and the goals and objectives, risk tolerance that they have at that particular time. We keep saying that, and people sometimes get tired of hearing us say that, but that's what it's all about, and constantly adjusting what you're doing to affect and take advantage of what's going on.
More to talk about here on the show. We're talking about what happens when interest rates go up. We have more to show you and more to talk about. Molotsky on Money is the program. I'm your host, John DeMasi, with Stan and Lee Molotsky from the SHM Financial Group, providing sound financial insights and strategies since 1958. We're coming back with more of this edition of Molotsky on Money. Stay with us.
your risk tolerance is when it comes to your investments? Do you know exactly what you have in your portfolio? The SHM Financial Group have developed a very important program called a financial stress test. It's simple, quick, and can help you in your future financial plans. Contact the SHM Financial Group to schedule it. Offices in Collingswood, Voorhees, and Lakehurst, New Jersey. Call 1-800-MONEY-SHM. That's 1-800-666-3974. Call us to discuss the reverse mortgage concept. If you should decide to proceed, you're required to go through a 60-minute phone or office interview. We will provide you with a list of HUD counselors you can call who will provide you with the counseling. Call us at 1-855-HUD-REVERSE. That's 1-855-483-7383.
Welcome back to Molotsky on Money with Stan and Lee Molotsky. I'm your host, John DeMasi. Don't forget, we put up on the screen from time to time the email address, the website, and the phone number for Stan and Lee Molotsky and the SHM Financial Group. If you have any kind of a question, any kind of an issue or situation you want to discuss with them, feel free to give them a call. They'll be happy to talk to you. And I do understand, Stan, that you do talk to a lot of people who've watched this and have a lot of questions.
Well, yes, it's an ongoing thing. We have different workshops all the time and the radio shows that we're doing. And actually, we've had some calls from the television programs that we've done. And just as an aside to this, if anybody wants to see any of these shows, they can go to our website and click on to the TV link, and they could watch, and it's listed the different shows with the different topics that they can sit and watch anything they want, whenever they want.
Modern technology at its finest.
Right.
Here on Molotsky on Money. We have been discussing tonight what happens when interest rates go up, and in this particular segment we have questions that have come in from a variety of sources, some from our radio shows, some from the TV show, and some from seminars. This is a question from Phil in Hamilton, New Jersey. He says, I've always been a believer in bonds. Now with interest rates going up, I'm afraid I've made the wrong choice. Should I get out of bonds now? If so, where should I put my money? Sounds like he's been watching the show tonight already.
Right. Well, the answer is yes and no. How's that for an answer?
Well,
Yes
that's kind of your normal answer.
Well, because, again, depends on the bonds he has and the maturities of those bonds and the other things that he may be invested in. If all the money is in very long-term bonds, yeah, he may be taking a big chance based on the fact that interest rates may continue to go up and the value of that bond portfolio could go down. But if the interest rate is high enough for him to absorb that shock, then it may not be necessary to get rid of all that. So we have to look at the specific, like Lee says all the time, you have to look inside the hood to see what's underneath and to see specifically what he actually has.
I think the beauty of our relationship is that we don't always agree, like a marriage.
Really? Father and son don't always agree? I've never heard of that.
I'm going to say, however, however, in this case, I absolutely agree with you. We had a case just recently where someone brought in a package of CDs, and they said, what do you think? And the normal response without looking is, you're all in CDs, you can't be earning anything. Totally not true in this case. Gentleman brought in $500,000 worth of CDs, approximately, about 6 different CDs. The rates on there were between 4 and 4.5%.
Which is good these days, right?
He had purchased them a number of years back. So in his case, CDs, keep them and hold on as long as you can until they mature. So if they are bonds that are paying 5, 6, 7%, okay, make sure you understand the risk associated and what kind of bonds they are and the maturity of those bonds if they're individual bonds. The problem is people don't understand the interior makeup of the bonds, how much risk that bond has, whether it's a junk bond, a AAA bond, a corporate bond, a tax-free bond. They don't understand what kind of bonds typically they have. So one of the things we do is do an analysis of their bond holdings to let them know the risk associated with those bonds. Then make a determination as to whether or not, as the questioner said on the email,
Should
whether
he get out of bonds
he should
now,
get
right?
out of that bond.
Okay.
So-
All right, we have more questions here, as we do at this particular segment on the show. This is from Harold in Berlin, New Jersey. Harold says, I've listened to your radio show and heard you say beware of bonds, especially municipal bonds. Does that still hold true, Lee?
Again, back to the question of depending upon the risk of that municipality or whether it was a bond or a bond fund. In a bond fund, you have no choice as to the bonds that are in the bond package. The manager chooses, he or she, the manager of that fund, chooses the bonds. So you may have a mass exodus of money from that bond fund, significantly affecting the value of your bond fund. In an individual bond, again, you should buy individual bonds, just a thought, in $100,000 denominations. Otherwise, you're probably paying up a little bit for that bond and sometimes overpaying a little bit. So be really careful and be aware. Just be aware of the ramifications in today's environment.
Stan, didn't we do a segment on the radio show about this a while back? And wasn't there a couple of towns going bankrupt?
Well,
and we were talking about that. So maybe that was where this question
Well, it could
came
be.
from.
I mean, for example, let's take this little town called Detroit.
Okay.
Bankrupt, filed for bankruptcy. Now, suppose you own the piece of paper guaranteed by the city of Detroit.
Worthless, right?
It's not worth much today because they're bankrupt, and they're going to renege on the debt on those particular obligations or pay you pennies on the dollar. So you can own tax-free bonds, and there are two types of tax-free bonds, as most of our viewers know. The general obligation bond, which is based on the taxing authority of the specific thing. Well, Detroit can't tax because they have relatively little revenue, so therefore there's no money to pay that particular interest. And then there's a revenue bond, which would be like the New Jersey Turnpike or the Pennsylvania Turnpike.
Where
or
you
the
know
Grid
money's
Authority.
coming in, right?
But
Okay.
maybe not. If people stop using the Turnpike because of the construction and you can't get from exit 4 to exit 6 without waiting an hour and a half in line. So,
right,
and
okay.
go up, there won't be the cash flow, and therefore the revenue could drop off and they may not be able to pay that. You have more of a problem with like hospital authorities and things like that. But again, you have to know what type of things that you own. And again, the analogy of looking under the hood to know specifically what you own is part of what we do and provide for clients.
Probably not a good analogy for Detroit, but yes, lift up the hood.
Yes,
Right.
Perfect. That's pretty good, Lee. We have another question here. I believe this is from Phyllis in Ballackinwood, PA. She says, I'm 73 and I'm afraid of losing money. My advisor says I'm okay, but I'm not so sure. I have about $300,000, most of it in U.S. Treasury bills. Am I losing money now, or is it possible for me to lose money in the future? Stan?
If held to maturity, you won't lose principal, but what you could lose is the buying power of that money. That's the problem that she has. And again, we don't know the maturity of those particular Treasury obligations. Are they 30-year Treasury? Are they 10? Are they 5? Are they 3? Are they 3 months? And again, we'd have to know specifically what that would be. But even if they are long-term Treasuries with a higher interest rate, the problem is those interest rates that she is probably getting is not even close to keeping up with inflation. That's her problem.
So she should probably be looking at other things.
She should be looking at other things in relation to what she's trying to accomplish, no question about it.
And with that, we're going to put the wraps on another edition of Molotsky on Money. Don't forget, if you would like to contact Stan or Lee Molotsky, we've given you the toll-free number, the website, the email address. Feel free to give them a call or email them. They'll be happy to talk to you to give you more information. For Stan and Lee Molotsky and everyone at the SHM Financial Group, I'm your host, John DeMasi. Always a pleasure. Thank you for watching. Oh, yes. Good night, Jenna. Good night, Alexa. We'll talk to you next.
Balancing safety and risk in your portfolio is very important. An easy way to do this is to use the rule of 100. The closer you get to retirement, the less time you have to recover from losses. Not adjusting your risk as you age can have a traumatic effect on your retirement. This system will provide you with the percent of your nest egg that should be allocated to either safe or volatile investments. Do you know how to classify your assets? Do you know if they fit your risk tolerance? Give our office a call today for a complimentary Rule of 100 report.
Call us to discuss the reverse mortgage concept. If you should decide to proceed, you're required to go through a 60-minute phone or office interview. We will provide you with a list of HUD counselors you can call who will provide you with the counseling. Call us at 1-855-HUD-REVERSE. That's 1-855-483-7383.